You've done a great job of saving, but how should you spend in your retirement? Also, Panasonic's growth has flatlined. Is the company a good stock to buy?
This is InvestTalk. Independent thinking, shared success.
Good afternoon. It is Thursday, June 20th, 2024. My name is Luke Guerrero, and this is InvestTalk, and I will be your guide over this next hour on our daily journey to become a better and more informed investor. Now, how do we do that? Who decides the direction that this financial car drives? Well, you do. Because most importantly, we like to take as many caller questions as we possibly can, as many YouTube questions as we can, as many iTunes review questions as we can. I pretty much just sit here hoping that you will call in live to 888-99-CHART, so please do not disappoint me today. With that being said, in a little bit, we'll cover the show's topics for the day and talk about the market performance. But as always, we like to get our first caller question as quickly as we can.
Hello, Justin or Luke, Chris from New York. I want to get your analysis on company Vale. Also, the ticker is VALE. It's about a little over 20% of my position. About 2% of my portfolio. I'm down about 22% on the stock. Wanted to see your thoughts if I should be adding to get a full position at 3% or if I should just cut my losses here. Look forward to the answer on the podcast. Thank you. Bye.
First, I had a minor heart attack when I heard 20%. That would have been never go 20% in one position, but 2%, way more reasonable. So let's get into it. Vale, ticker VALE, is an ADR. It is a Brazilian company. It's headquartered in Rio, and they are a steel and metals company. They have 61% of their revenue derives from their iron ore solutions segment, and they have energy transition materials as well that makes up a little bit of their business. Now, this company is, for lack of a better term, a cash cow. It generates a lot of cash flow, and it likes to distribute that back to its investors in two ways. Buys back shares, which it's been consistently doing since 2021, and pays out a dividend yield. You can see their dividend yield is kind of all over the place going back the past 5 years, about 3.2% yield in 2016. And that fluctuated in the 2 to 3% range for a while, popped up to 20% in 2021. And then it's been all over the place, 8% 2 years ago, 4% last year, and it's supposed to be 11.6% this year. And so the reason why that's been fluctuating all over the place is because the price has been up and down. Sure, when demand has been rising and falling, they still like to distribute to investors, which is good. But their dividends per share has been also all over the place as well. So it certainly is profitability dependent. Their payout ratio is about 72%, so that makes sense to me. In terms of market cap, they're a large cap company, $47 billion, only $13 billion in debt, which means their interest coverage ratio is 11 times. That's perfectly fine. Their earnings forecast has been up and down and volatile as demand and the price of the underlying commodities has been as well. And although they improved their margins a little bit back from the 2018, 2019, 2020 years, it's improved to 45%, 38%, 19%. That, again, is all due to the type of business that is being run here, what the products are, and the underlying commodities here. Now, the question becomes, why is it down 20% over the past year? Why is it down 30% year to date? Well, that's because, frankly, it's headquartered in a country that has economic, political instability. And so Brazil has been a place where there has been some meddling from the government. Because of, one, how the business is run, two, how the profits are used, and three, foreign ownership. And so this recent run down in price has been really related to some risks associated with political intervention in the country. And so if you're willing to stomach that risk, and that's why if this moves to outperform over the next year, it's really compensating investors for taking on that level of risk, then if you have that level of risk tolerance, fine. This company, like I said, is a cash cow. It likes to buy back shares, likes to pay it out in dividends, pays out 72% of its profits in dividends. For me, I think there's just too much political risk here. I think there are better ways to spend your money. It may be near the bottom. Let me take a look at what the chart looks like from a technical perspective. I mean, it just broke its recent support around 1160, so it could be heading lower here. I don't know. I think this is an opportunity for, if you're not too much of a risk-enjoying individual, if you're risk-averse, or even if you're just not risk-loving, this might be an opportunity to just move on and move elsewhere. Thanks for the call. Now, we got a lot of ground to cover over the next 45 minutes or so, and here's some of what I have planned, time permitting. My main focus point concerns this question. the psychology of retirement income from saving to spending. Are you lost in the retirement consumption puzzle? In order to think about this, we have to first talk about what it means to save for your retirement in your working years. Then really how your income changes in retirement, how your costs change in retirement, and how your investing changes in retirement. We'll also talk a little about housing prices, who despite higher interest rates may start to soar again. So why is that? Is this just a US thing? Is this regional? Is this national? What are the effects for people who are looking to buy into their first home or perhaps their second home? We'll also talk a little about AI stocks. Everybody's heard of the AI wave, and NVIDIA has done particularly well. But what about those stocks that were doing well in 2023? How are they faring so far in 2024? Also, should we have time at the end of the show, we'll try once again to get to the topic of the government's lawsuit on Adobe for its practices in what the government says is deceptive behavior to charge customers in ways that they don't fully understand. We also have plenty of caller questions to get to, including one of GRPM, which is the Invesco S&P MidCap 400 GARP ETF, and one on issued shares. We also have some questions that came in from our InvestTalk YouTube channel's comment section. And of course, we welcome your finance and investment questions now or anytime, really anytime, any day on 888-99-CHART. Now we're heading into a short break, and on the other side, we'll talk about today's market activity. Please remember that you can call anytime and leave your questions on the InvestTalk voice bank. Call now at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast. Let's talk a little bit about the market today. U.S. stocks are mostly lower. The Dow was up, though, 77 basis points. The S&P 500 down 25. Small caps slightly underperforming, large caps down 39 basis points. And that was really a bit off of the worst levels that we saw throughout the day. Momentum and growth for a change, lagging value, something we haven't seen in the past couple weeks. Big tech was the large dragger on stocks today. NVIDIA and Apple down after their robust rallies over the past couple days. Oil companies, metal companies, auto parts among the outperformers for the day. Gold finishing up almost 1%. Crude oil ending up almost 70 basis points. And really, price action reflected some consolidation across the recent AI winners after NVIDIA surpassed Microsoft's market cap on Tuesday to become the most valuable public company. Really the recent AI tailwind has kind of played into the concerns surrounding index concentration. You still see some pretty weak breadth, even though the S&P equal weight index did outperform today, there's still weak breadth across the market. And so there's been some concerns about that and how that relates to the growth worries overall. A few other notable drivers in play: record OPEX tomorrow, flash PMIs also looming for tomorrow, and a softer batch of economic data today with some discussion about those near-term headwinds and overbought conditions. A busy day of economic data included initial claims, which missed, though slightly off last week's 9-month high that triggered some of those growth worries. Continuous claims also a bit higher than expected, highest since January actually, and second highest since November of 2021. Housing starts and building permits for April, both below expectations, and the Philly Fed Manufacturing Index mixed as the employment index remained negative as well. That was the market today. Now I'm here and ready to take your caller questions, as you know, but now let's play a question that came in earlier.
Hi, my name is John. I'm calling from St. Louis, Missouri. I called a little while back regarding the S&P 500 GARP ETF, SPGP. This time I'm calling regarding the mid-cap version of that GARP ETF. The ticker symbol is GRPM, Golf Romeo Papa Mike. I was calling to see what you guys thought of it. It has the growth at a reasonable price principles regarding mid-cap stocks in the S&P 500. I'm just calling to see what you guys thought of the MidCap version, it's GRPM. Thanks for your time.
Yeah, so GRPM, which is the Invesco S&P MidCap 400 GARP ETF, seeks to give you midcap index exposure to growth stocks with perceived quality and value characteristics. So for me, it sounds like it's going to exclude the priciest of the stocks within the midcap space, though still leaning a little bit towards the growth side of the market. So let's see how it does in terms of its market cap breakdown. Large caps make up about 16%. Mid-caps making up the bulk of the fund at about 80%, and no small cap weight in there. As expected, you have high energy weight relative to the USA Mid-Cap Index. It's tilting towards consumer cyclicals, materials, and underweight technology. All to be expected, all US names. All this makes sense to me, and it's doing this for you for about 35 basis points. Yeah, 35 basis points. So the price to book of the fund, because of that, is going to tilt more towards value. It's 2.33 relative to the segment benchmark, which is 3. So as this number gets lower, it means you're paying fewer dollars for an equal amount of book value, right? So as you get to lower numbers, that's value names, higher numbers, that is growth names. How does that bear out for price to cash flow? Well, you're certainly a little bit, tilted towards value on that as well. Price to earnings tilted towards value. Price to sales below 1 on a weighted average basis. Again, weighted average market cap around 10 billion. It's tilting towards those mid caps. So all this looks good. I think one thing that's important to note is, even though it hasn't really been the case recently, that with small caps underperforming large caps, empirically speaking over the long term, there still is a data set that shows that small caps outperform large caps, small caps outperform mid caps outperform large. That small cap premium is monotonic, which means it moves along a line. Expected outperformance decreases as you get larger across the spectrum. And that certainly bears out in longer time horizons. And it makes sense sensibly, right? Because you're taking on more risk. Therefore, investors are expecting and requiring higher return for taking on that risk. And so when you're looking at investing in a growth fund, if you want exposure to growth names, I certainly think that a mid-cap index, which is going to tilt smaller than large caps, of course, a mid-cap index that is tilting away from the growthiest names, the highest price names, but still giving you that growth stock exposure, I think is a better way to go about targeting growth. So I think this does it for a reasonable cost, 35 basis points. How many names does this thing have? Only 59 names. Crocs is the number one name. Interesting. But yeah, so I think overall this is good fun. If you want mid-cap exposure, you still want some growth exposure, but you don't want to have the highest price stocks. I think the Invesco S&P MidCap 400 GARP ETF might be the way to go. Thanks for the call. Now, I hope you've been telling your friends and family that our InvestTalk audio podcast also comes in video form on our YouTube channel. And so let's get to a question from the comment section right now. It says, "Hi, Justin and Luke. It's Matt from England, looking at Amdocs, ticker DOCS. Everything looks good from what I can see. It looks undervalued." So let's take a look at DOCS. And so Amdocs is a software products and services. It's a company that provides software infrastructure for telecoms primarily. And so you see that 58% of its revenue comes from its managed service arrangements. That's from the telecom businesses. And geographically, it's mostly in North America, 68% in North America, 14% in Europe. And so like a lot of companies that have serviced telecoms, it's not had a great year. It's down 11% year to date. And a lot of that is because its sales are pretty stagnant. And so it's kind of lost a lot of that support that it had earlier. It's broken down beyond its $78 level. And it's trying to find some more support at the 75 level. Now, they've been buying back shares consistently. We like that. Their earnings have been upgraded consistently. We like that. Cash flow is improving and profitability is improving as well. So we're actually going to head into a break right now, and still to come on this podcast, my thoughts on DOCS and hopefully more live caller questions, as well as my main focus point today. So stay tuned and call us anytime at 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Thanks for watching, and don't forget to like and subscribe and turn your notifications on, because you don't want to miss a single episode of the InvestTalk podcast. So before we headed to the break, we were talking about Amdocs, ticker DOX, and the software company and services company for telecoms hasn't had a great year. It's down 10% year to date. And so one of the original parts of the question was, is this undervalued? I don't think it's undervalued. Its price to earnings is at 11 right now, which is near its 5-year average of 14. Price to book is about at its 5-year average. I think that the problem here is they've just kind of slowed down in terms of revenue growth. So their annualized revenue growth over the past 5 years is about 4%. And that's not just because they've had no growth. It's been a steady 4% over the past 4-5 years. So certainly this isn't a big grower. Excuse me. This isn't a big grower. I think that the market's fairly valued at it right now. I think it's kind of breaking down in terms of its support. So if you want to keep it on your watch list, feel free. It's got low debt. It's not a lot of short interest. Dividend yield's pretty consistent. It looks like that to me. So I think it might be a fine name, but certainly it's not undervalued. And so if you're looking to get it cheap, this is not the time to get it cheap. Maybe keep it on your watch list. Thanks for the call. Let's go to Sid in North Carolina, who has a question about V. Is that your question? Your question about V?
Yes. Thank you for taking my call. That's Visa.
Yep.
I do own this. I think approximately 1% of my portfolio. I picked up around 190. It's currently around 270, 280. Just like to know, should I hold for a long term, or is it the right time to just take some profit, or what do you suggest? Thank you so much for your time.
Yeah, of course. So V, I think everybody knows who Visa is. They're one of the two major money processing services, Visa, MasterCard. A little bit of Amex, but really Visa and MasterCard hold most of this market. And there was actually an acquisition earlier in the year from Discover, who's trying to break into this a little bit, but still, certainly, Visa still holds a lot of its power within this space. And so in terms of revenue growth, 9-10% over the past 5 years annualized. Very, very good. Their cash flow and profitability have improved. Their cash flow has actually doubled in the past 4 years, which is fantastic. Their profitability is improving as well. If you take a look down here at their net margin, like a lot of financial services companies, their margins are pretty high. So they went from about 48% in 2018 to 52% in 2023, and they're projected to be 56% this year. Debt levels, $20 billion in debt on a $547 billion market cap company. So debt is certainly not an issue here. Why is that? Because cash flow is fantastic. Earnings have been upgraded pretty consistently. They pay a dividend around 50 to 70 basis points, again, fairly consistently. And they've been increasing that dividend every year for the past 5 years. Now, in terms of their relative valuation, about 25 times, very normal for this type of business, about 14 times on price to book. Again, the asset levels here are a little wonky, so I wouldn't read too much into that as being overly expensive. I think what you got on your hands here is a name that has returned well and isn't too overly priced, and I just don't see any technical indications as well of it really breaking down too heavily anytime soon. I think so long as it holds that like 265-ish level, I think there's no reason to start selling it. You said you held around 2%, is that correct?
Yes.
Yeah, I think that's a perfectly fine percentage to hold. So again, if it starts to break down past 265, maybe start to revisit it. But for now, it doesn't look overly overvalued or anything, and it seems like it's running smooth. So thanks for the call. Now let's shift gears and start talking about my main focus point today, which is about the psychology of retirement income. Because people spend a lot of their lives saving, and then when it comes time to start spending, it's tough to flip a switch to make that change. And so saving for retirement, like I said, is a big part of most people's lives, or at least it should be. But when the income in retirement changes drastically and your investing for retirement is done, how should you spend? Now, this phenomenon where retirees fail to spend their accumulated wealth, often referred to as the retirement consumption puzzle, presents a unique challenge in financial planning. Seems kind of paradoxical, right? Individuals who've worked hard to save their retirement then hesitate to use those funds to enhance their quality of life. But that's the case for approximately 1/4 who spend less during retirement, even when they have adequate resources to maintain or even improve their lifestyle. The issue is deeply, deeply rooted in both economic and psychological factors. Firstly, many retirees experience a significant lifestyle shift upon retiring, which naturally decreases their expenses. They pay off major debts, such as mortgages, that can significantly reduce monthly expenditures. From a psychological standpoint, the shift from saving to spending can be pretty jarring. Like I said, the uncertainty of lifespan and potential future medical expenses can further exacerbate a retiree's financial conservatism. The concept of shifting, again, from this phase where you've been saving for 40 or so years leads to a heightened sense of loss aversion. It's a principle of behavioral economics. It means that you're more worried about losing than you are from the pleasure you derive from gaining. And so that's a psychological barrier that a lot of people have to face. So for retirees, the fear of running out of money can really outweigh the satisfaction of spending it, even traveling or doing their hobbies. So today's retirees are navigating a vastly different economic environment than previous generations. Why? Well, there's been a wholesale shift from defined benefit plans to defined contribution plans. People don't have pensions as much anymore. Pensions were good because, yes, they're a guaranteed source of income, but it's also a steady source of income. You know what you can plan for. So addressing these issues requires personal introspection and strategic financial planning. Financial advisors often recommend tracking spending to identify areas where psychological barriers may persist, but ultimately, the puzzle highlights the need for a balance between prudent financial management and fulfilling personal enjoyment in retirement. Now we're headed into a short break, and when we come back, more caller questions and some more stories to talk about.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions. Now, on the next Invest Talk, we'll look into this topic: how and why buy now, pay later debt could become a problem for the U.S. economy. There's currently no way for economists, regulators, and analysts to know how rapidly buy now, pay later loan debt is growing, which could lead to unforeseen economic consequences. That's tomorrow, but for now, let's get to one of our callers from Hayward who has a question about HIMS. Do you own it, or are you looking to buy it?
I own it. I got in around at $4, and as you can see, it's been on a tear. So I'm not sure if I should sell it, buy more, or hold, or wait for a pullback, or what.
Well, before I answer that, how large is it in terms of your overall portfolio?
I would say it's 10%.
Okay, trim it. Absolutely trim it. 10% is too much to have exposure to one company, any company. It's just too much exposure.
Okay.
In terms of a risk mitigation standpoint. Regardless of if it's continued to tear, investing is about more than return. It's about risk mitigation as well, right? So, but that's any company. Now let's dig into HIMS. So HIMS is a telehealth consultation platform, and they make money by offering telehealth services and shipping medications, weight loss medications, sexual health medications, mental health medications to your doorstep. And so recently they had a little bit of a drawback. Their CEO made some comments that were poorly received about the Middle Eastern conflict that's going on right now. And so their stock kind of retrenched a little bit. But the reason why it's been on a tear is because they've had, I think, 12 consecutive quarters of earnings beats, which is fantastic. I mean, it's a relatively new business. It's not a new business model per se, but it's a relatively new business. So, their net margin has, they're supposed to make money for the first time this year. Certainly, I don't generally like to invest in businesses that aren't making money, but I believe they made money in previous quarters. Yeah, it looks like they made money in December is when they started making money. Sorry, September, June. There it is, June. So, generally speaking, I think, again, you should definitely trim. 10% is way too much. It's okay. for your knowledge, trading currently at a forward-looking PD of 84% or 84 times, which is incredibly expensive. And I think in the long term, again, this isn't a new business model. I could see companies like CVS, Walmart, who are really trying to capture a lot of the online business, kind of move into this space and supplant some of these larger businesses. I don't have any issue with you holding on to a little bit of it, but either way, you should trim that down to 4 or 5% at the most.
Okay.
Awesome.
Thank you so much, Luke. I appreciate it.
Yeah, thanks for the call. Now, shifting back to another interesting thing I saw today, and that is about the housing market. And so the question has to be asked, is a new housing boom on the horizon? Recent data, in fact, indicates that global housing prices, with the exception of China, have risen by over 3% year on year, with substantial increases observed not just in the US, but Australia, Portugal, the UK. And despite the prolonged period of high interest rates, housing markets in various countries appear pretty robust. Some of this is regional. Regions like San Francisco and Phoenix in the US saw notable declines. But it appears that the burden of higher interest rates, and therefore mortgage costs, have raised concerns evidenced by a significant increase in the percentage of people struggling with housing payments. Surprisingly, the downturn was actually pretty brief, marked as the shortest in history, lasting just a few months. And despite fears of a significant crash due to high rates, that hasn't happened. In the US, mortgage delinquency rates are actually at historic lows. The resilience of the housing market is often attributed to the widespread use, especially in the US, of fixed rate mortgages, which shield homeowners from fluctuating rates and discourage selling due to the necessity of securing new mortgages. That's something we call the golden handcuffs. Beyond just mortgage structures, other factors contribute to the strength of the housing market, including high immigration rates, financial sacrifices by homeowners, and a robust economy. In terms of economic health, despite higher interest costs, increased wages, and low unemployment, it's helped maintain affordability and spending power among homeowners. Central banks in some regions outside the US have begun cutting rates already, which may further buoy the housing market. And continued wage growth and easing inflation are likely to provide further relief. If things get cheaper elsewhere, you can spend more on housing. That could potentially sustain or even increase demand for buying homes. Thus, the housing sector is complex. It's a critical component of the global economy. And it might even see continued growth despite what everybody thought would happen a mere 2 years ago. Now let's head over to our InvestTalk YouTube channel where we have another question in the comment section. This one on TAYD. It says, what are your thoughts on TAYD? It's a very small cap stock with good fundamentals and good historical performance. Well, first, we will say that historical performance is not indicative of future results. That is the, say, number one rule of finance. But Taylor Devices is a manufacturer and marketer of shock absorption, rate control, and energy storage devices. And the big benefit to Taylor over the past year has really been the increase in growth in one of their segments, specifically their aerospace and defense segment. So that's now their fastest growing segment, which is good for them for two reasons. One, if you read the news, you know that defense contractors are hiring at a higher rate than they have in some time. And two, in a manufacturing business, in a development business, in a supply business, aerospace and defense tends to be stable rather than cyclical. And so with this, the company's seen record revenues, backlog due to investment in product development, and widening margins. Let's take a look at their margin increases. Yeah, I mean, going back to 2019, 7.6%. Now it's up to 15.6% in May 2023. They don't have any forward projections, it looks like, for this year. And that could be because it's a very, very small company. Not too small. It's still a small cap. I wouldn't call it micro cap. It's $139 million. But overall, like I said, there's some benefits to this company relative to the other companies within its industry. Now, I wouldn't say it routinely beats out its industry, right? You see its past performance, although positive in 2022. On a 5-year basis, it's underperformed its industry actually by 7.9%. So we'll keep that one there. But cash flow's been improving. Profitability's been improving. They have actually no debt, but they also have no cash on their balance sheet. And so I think that this is the type of company that, although cash flow is slightly positive, they may take on some debt soon. They may issue more shares soon. They haven't done that in the past 5 years, but with a run-up, if I was on their board, if I was a manager here, I would probably suggest issuing shares. But overall, I think this is a fairly well-run business, it looks like, with the growth within that particular segment that, again, is not predisposed to being cyclical. That's fantastic. It's trading at a modest valuation, 2.7. So I'd be okay with you putting a little bit in it. I don't see any glaring issues here. Again, I like the segments that are growing within this business, and I like the 10% year over year sales growth, and I like the reducing costs and increasing margins. So overall, thumbs up, but keep in mind, all small caps tend to have higher levels of risk than their large cap counterparts. Well, 2024 is moving very fast, and we are just about through the second quarter. You may notice that we've been telling you for quite some time that it is a new market environment, and there are many reasons for this. So serious investors need to be able to adjust their thinking and strategies to fit the times. Let me remind you that here on InvestTalk and at KPP Financial, we operate with a philosophy of independent thinking, shared success. At KPP, we offer unbiased guidance, practice parallel investing, where we invest in the strategies we manage for ourselves alongside our clients. So I encourage you to take advantage of our offer to provide a free portfolio review assessment via telephone, Skype, or GoToMeeting. Send us a message on investtalk.com, and either myself or Justin would love to talk about your portfolio.
Hey, Luke and Justin. Bill from Philadelphia. I just need a little clarification. I know you guys, companies that are big issuers of shares, not a good thing, not good for the balance sheet and all that kind of stuff. And I was just wondering, how is issuing of shares different from, say, a stock split, like NVIDIA, with a 10-to-1 stock split? So are they essentially issuing 10 times the amount of shares? Also, Apple has had a number of splits over the years. So just want a little clarification of stock split and share issuing. Love to know too. Thank you very much.
So when you are running a business, there are two ways for you to raise capital. You can issue debt, or you can issue equity. And so when we say issue shares, what we mean is the company is creating shares, selling them on the market, and diluting current shareholders. If you owned 5% before shares are issued, and more shares are issued and you didn't buy any of the new shares, then you own fewer shares as a percentage of the company after the share issuance. So that's different from stock splits. So there are stock splits, and there are also reverse stock splits. What NVIDIA just did was a stock split to bring the price of the shares down. Typically, when prices get too high in terms of per share value, companies like to bring it down. It does absolutely nothing in terms of capitalizing the company. It is just something that happens on paper. From an economic framework perspective, nothing has changed. So sometimes companies do this to bring the price down, or sometimes companies do reverse stock splits to bring the price up. Why might they do that? Well, maybe their stock is trading at pennies, and they have to be above the $2 threshold that you have to continue to be listed on some of these exchanges. So generally speaking, stock splits, reverse stock splits, that's all on paper. Nothing has changed. You have the same percentage you had before the split happens. Now, issuing shares, that's how you raise capital. Existing shareholders, unless they buy a proportional amount of the new issuance, are going to be diluted. So that's the difference right there. Thanks for the call. Looks like we have another live call from Frank, who has a question about PCRHY.
FY.
Oh, FY. Okay. Well, that's important. We gotta get this whole thing. Panasonic. Do you own it, or are you looking to buy it?
I own it. I've had it for about a year, and I just want to know if I should get rid of it.
Okay. Well, you've held it for about a year, which means you're down about 22%. Is that correct?
Yes.
Yeah, so it looks to me like one of the issues here is not that it's overly priced. I mean, its forward-looking PD is pretty in line with its averages. It's that growth has just dried up. So you saw a lot of purchases coming out of the pandemic into 2022, but from 2023 into now, and even projecting towards the end of this year, there's pretty much nothing. And if you exclude the pandemic slump when supply chains were really crushed, where that growth happened, over the past 5-year time frame, sales growth is only at about 1.2%. So I think the problem you have here is you have a company that has technically been underperforming its benchmark index for quite some time, underperforming its industry with not a lot of growth and actually margins that have been slipping. So, I think probably it would be best to cut your losses and move on.
Yeah, thank you very much.
Of course, thanks for the call. Let's shift gears once again and talk about stocks that have been doing well. Now, some of them have, and some of them haven't. And really what I'm talking about is AI stocks. Most stocks associated with last year's artificial intelligence trend, hype, have actually declined this year. And a lot of that is investors trying to distinguish now between companies that can substantiate their AI claims and those that can't. Despite the early excitement, the reality is setting in that mere mentions of AI are insufficient for sustained investor interest. I recently saw a company that was selling a computer mouse that had an AI button. NVIDIA, a leading chip designer, has seen its value soar, becoming the world's most valuable listed company, driving discussions on whether US stock market trends are fueled by speculative hype. However, the broader market has been less forgiving to companies riding the initial wave of AI enthusiasm. Without tangible evidence of AI capabilities, companies are struggling to maintain investor confidence. According to Citi's AI Winner Basket, which tracks stocks popular among AI investors, over half of them, more than 50%, have seen declines this year, despite the sector's overall hype and NVIDIA's success. Investment funds with a focus on AI, such as BlackRock's Robotics and Artificial Intelligence ETF and others, from Invesco and First Trust, have also experienced mixed results, with many constituent stocks falling. So how do we visualize the winners? How do we decide who the winners are going to be? How do we check stocks that give us the best opportunities to have higher expected returns? Well, a lot of that we talked about actually in a way in our most recent webinar that's available on YouTube about digging deeper than dividends. And that's the importance of solid, consistent earnings. The market's response to earnings reports have been quite severe. Companies that have missed expectations have faced some harsh penalties. Salesforce experienced its worst single-day drop in, I think, 20 years following disappointing earnings. Now, while some view the market's discernment as a return to rationality, let's not get ahead of ourselves. The ongoing AI rally is potentially indicative of a bubble, let's be honest. In historical scenarios, smaller companies, like the ones that have not done well this year, typically falter before the larger ones do. Despite the potential for AI's long-term impact, and it certainly is there, the market still may be overestimating the speed at which AI will deliver substantial benefits, leading to inflated expectations and speculative investments beyond their fundamental value. So it's important to only invest in companies that aren't trying to sell you on the hype, that don't just put an AI button on their mouse, but ones that have substantial changes, benefits existing in their bottom line, in their earnings, quarter after quarter. Now, this is InvestTalk, and I'm Luke Guerrero, and we have one goal here: to help you achieve financial freedom. Our work continues after this break, so get your questions in now to 888-99-CHART. You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Hi guys, great show. I have a question. I'm thinking about buying funds from Brazil. With the strong dollar, I thought maybe this is a good idea, and I see two on the horizon. First one is symbol EWZ, and the second one is FLDR. What do you guys think? Which one is better? Thank you.
Okay, so EWZ and FLBR, I think we only have time to look at one of them. So we'll look at EWZ, and that's because it's a very large fund. It's the iShares MSCI Brazil ETF. And so it's a large and mid-cap index that covers securities in Brazil. No single issuer exceeds 25%. All issuers with a weight above 5% do not go above 50% of the index weight. And so what you find in a lot of emerging markets is they tend to be very top-heavy markets. And so if you have a market cap weighted approach, you could have too much exposure to any individual security. That's a problem for two reasons. It's a risk issue, but it also could be a regulatory issue in terms of having too much ownership in any individual company as a foreign investor. So this fund is doing it to the tune of 59 basis points, which is to be expected for an emerging market fund. Again, iShares is not they're not a small fund group here. So they're doing it for probably about as cheaply as you possibly can. It tracks the MSCI Brazil IMI index, and it looks like Its price return is pretty in line with the index over the long term, so they're certainly doing a decent job, a net of fees, of tracking the index. And so like I said before, it's primarily large and mid caps. You're going to get 60% in the large caps, about 35% in the mid cap space, probably a little bit of cash in there as well. Some preferred shares. That's interesting. 70% equity, 20% preferred shares. Well, that's going to be Brazilian. It's just going to be a market cap, vanilla, weighted fund. Has about 50 holdings. Look at Vale in there. We talked about that earlier in the show. Yeah, I mean, this is exactly what you're going to want if you want a broad-based market exposure to the market of Brazil. It's going to exclude small caps, but specifically in the emerging markets, those are going to be not only the riskiest to hold, but are also going to be the most expensive to hold as well. So once again, if you just want broad-based market exposure that limits some of your downside risk by not investing in the smallest companies and not overweighting some of the largest names, EWZ, it's a perfectly good way to do it. Thanks for the call. Now, before we head off for the day, something that I've been trying to talk about for a couple days is the FTC's announcement last Monday that it is taking legal action against Adobe and 2 of its executives for allegedly misleading consumers about subscription terms. The FTC accused Adobe of not clearly disclosing the early termination fees. Spoiler, full disclosure, I fell for this as well, associated with its most popular subscription plan, making it difficult for customers to cancel. Adobe plans to contest these allegations in court, asserting that it prioritizes customer satisfaction and transparency in its subscription agreements. According to their general counsel, the company maintains a straightforward cancellation process. I disagree. The Department of Justice has filed a federal court complaint on behalf of the FTC, which details how Adobe allegedly steered customers towards an annual subscription paid monthly without adequately informing them of the hefty fees for canceling within the first year. Essentially, what they were doing was you would sign up for a monthly subscription, or you'd sign up for a trial and forget, and you'd have the monthly subscription. It would tell you $50 a month. What it wouldn't tell you up front is that should you cancel in the first year, you have to pay 50% of the remaining fees. So that's the issue here. This is all part of the FTC, the Biden administration, the DOJ's war on what they have dubbed junk fees. And so they're highlighting that on their website, Adobe's website, defaults, like I said, to this payment option, where people don't realize they're going to pay this 50% fee. So further scrutiny revealed Adobe's website does note a fee for cancellations made after 14 days, but fails to specify the amount up front. It's kind of hidden a little bit. And so there are further complaints filed not just by the FTC, but the Better Business Bureau. I think overall, this is a good trend. Be it concert ticket fees, be it hidden fees within airlines. I think the benefit of having a capitalist society is only such when things are transparent to all market participants. So I think everybody, both sides of the aisle, can agree that when businesses act in a way that is somewhat predatory and taking advantage of customers or hiding things from them, certainly it is the government's responsibility to come in and say, no, don't do that. Now, my name is Luke Guerrero, and this completes another episode of InvestTalk. I thank you for listening and hope to encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify, and please be sure to review and rate us on iTunes. I hope you've heard by now, and certainly you have if you've been listening, that we now are available in video form on YouTube. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, Make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.